Wednesday, May 15th, 12:54 p.m. New York time. Welcome to Winning Wall Street's Money. Self-explanatory. I have a YouTube page. The link's below if you want to join. It's for free. As well, I have a Patreon page if you want access to this content at the same time I post it, as well as a lot more inside of the markets and trade ideas. That link's below my Patreon page. As well, if you want to make a donation one time, I have a PayPal and Venmo link. They're below. Going to discuss the yields, bonds, notes, currency, Forex market. I have some trades I've been showing for days, weeks, and months for setups to my Patreon members. Those financial assets and the instruments that could be used between the options and the equity market. That's a lot of information. Let's get straight to the charts. Look at the yields. There are yields that trade in the futures market. You could directly trade them with the contracts as well as the options. The Federal Reserve controls interest rates as well, too. They have a vote. But the individual yields, the markets, the traders, the investors, they decide. So we're looking here at a 5-year chart on the 30-year yield. Each candle's a week. And look at the market cycle. 2023 high right here. We're below that. 2023, we're above that. So we're inside the range of last year for the 30-year yield. We have that accumulation phase here, markup phase, distribution, markdown, and zoom in. And then from that markdown, we had the markup, retracement. That was the high of the year. Then we had the dump. Here we are right now. Yep. So I was bearish the yields, which is inverse being bullish the bonds notes. I was expecting these prices to go down. As they go down, you'll see momentarily showing the other chart how the bonds and notes went up. So I was trading bearish this. Notice also the huge dump, panic selling here, light retracement. That means that bulls were not so strong on the upside. Another sign of less likely momentum continues to the upside. Again, 5-year chart on the 10-year yield, which is a shorter duration than the 30-year. Zoom in. Same thing, look at that. Markup from this being the markdown. And this year, again, the low of this year, low of last year, we're doing markup. Huge dump right there. Now, the shorter duration, again, 5-year chart, 5-year yield versus the 30 and the 10. The high of last year, the low of this last year. So we're still inside the range. Zoom in. We've got a huge dump also. See it? See the correlation? Higher duration, lower duration, they dumped. And also, again, you see the big panic selling last year and the light retracement on the upside. And again, 5-year chart. On the 2-year yield, very short duration. High of last year, low of last year, huge consolidation. And that huge dump past week. So you can see much more reacts faster on the shorter time frame here. Let's zoom in a little bit more so you can see each of them. Take the highs of last year. In the top left, the 30-year, top right, the 10-year, the bottom left, 5-year, bottom right, 1 year. They all have that little minor consolidation over here for the highs of this year. And that huge dump, panic selling. Panic selling on this means, again, the yield's going lower on these. Inverse, they don't anticipate interest rates to go higher. That's good for you people holding debt, be it on your credit card, your home, your automobile, something else. Your interest rates should not be going higher. But again, in part, the correlation to the Federal Reserve also has to make a determination. But when you look at your financial instruments, or your adjusted rates, this is part of the correlation, depending on which one you're in. You might have a credit card, maybe doing the 10 or the 5, and the mortgage, maybe the 30 or the 10. Those are part of your choices. Now we're going to go over the correlation, because I've been bearish the dollar as well too. The left is the US dollar. The right is the 10-year yield. Looking at a 1-year chart of each of them. So the US dollar here on the left, here's the high of last year. Here's the low of last year. We're inside that range. I already mentioned that was on the 10-year yield. Bearish the yields, bearish dollar. Here's the high of this year. Big panic selling, coming back up on weakness. Nice dump. So I was looking for the setups on the higher time frames and the triggers on lower time frames. Worked out very nice. Go on to the next. Now talk about the bonds and the yields. Again, these instruments I'm showing you, or if you want to be like the other people call them assets, I'm looking at the futures market here, but as well, they have stock ETFs on these. So I was looking at the 30-year yield. You can also relate to it as the 30-year US Treasury bond. Again, 5-year chart, each candle is a week. So the yield was going one direction and the bond goes inverse. So I was showing you that dump on the 30-year yield. The inverse happens here. See that? Nice. Having the bonds go up. So again, the higher duration, the 30-year, is referred to as the bond. I showed you earlier was all the yields, 30, the 10, the 5, 2. Those were all yields. But these assets, the Treasury, bonds and notes, there's a symbol. So 30-year is a bond from the Treasury Department. And from the Treasury Department, they have a 10-year financial instrument called the note, symbol there. And again, the Treasury Department has 5-year, refers notes. So the shorter durations under the 30-year are the notes, and the 30-year higher is the bond. And the 2-year, it's a note. But I choose to chart the yields. The first ones I showed you. I'll move that back over so you can see again. Right here, the yields. Again, the 30-year, the 10, the 5, and the 4. Sorry, the 30, the 10, the 5, and the 2. And when you look at it now on the bonds and notes, simply the inverse. See, they're trading up green the past few weeks. Whereas I showed you on the yields were red. Got it. It's good. Let's continue to go a little bit more. Now we're looking at the daily chart, the 10-year yield. And the inverse, the 10-year note, stock ETF, TLT. Remember I said it was bearish yields, consolidation, fake out. This is a consolidation. I was interpreting this as a stop hunt. And then there was another stop hunt here. Yep. Past day tested it. What a fake out. Met a bunch of new buyers up there being bullish. They were wrong. They got trapped and it smacked down. And then today broke the swing low right here, which was, I would term that as a short-term bullish stop hunt, but this was a bearish stop hunt. What a fake out. And nice, huge dump. Close my position from gains to profits today using the options on TLT. So look at this today, gapped up. This trades nearly 24/7 on the left. It's the futures. And this is a stock ETF, just trades from 9:30 a.m. to 4. Nice pop, as expected. Worked out well. So that being said, the economy and the financial economics report today, the past few days, again, showing less likely that rates would be raised. And again, rates could be kept on pause longer. The Federal Reserve has left rates on pause for a long time, over a year. Again, these individual trade based on market sentiment. Again, yields go lower, interest rates go lower. So again, the point is here, less likely the Federal Reserve, aka central bank, would raise rates. Yeah, for the past 6 months, you have talking heads on business channels saying that they believe the rates were going to go higher. They were wrong. And you had for nearly 2 years, financial news networks say that the Fed would lower interest rates. They didn't. They left them on pause. So what I'm showing you here, regardless of what those knuckleheads said, there's trading opportunities. Yeah, very nice. Thank you as always for spending just a little bit of time with me. That's it for the video. Thanks for watching.